Do you know what an orphan account is? Do you know the 7 mistakes you can make when you're trying to pick an advisor? Coronavirus, how does that affect the market? What are the 4 C's of banking? And have you heard anything about opportunity zones? Well, folks, stay tuned because we're going to be talking about all these things today.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
So what is an orphan account? Folks, this is just simply an account that you might have out there that you don't have an advisor associated with it anymore. You know, if it's an insurance product, maybe it was life insurance, maybe it was an annuity, there was an agent some time ago that sold it to you and you see his name listed as the servicing advisor. Well, what if he's no longer in the business or he's no longer with that company? You could very well find yourself an orphan account in that regard. What if it's managed money or mutual funds that you were sold and again you had an advisor, he's listed on the statement, but now all of a sudden he's not associated with that company anymore. A lot of times you'll find they'll just reassign you to somebody else, but in that particular case you've got an advisor of record, but the advisor isn't servicing the account any longer. I would recommend or encourage you that if you find that to be the case for yourself, then you're going to want to get an advisor associated with it. In regard to any kind of insurance product like life insurance, annuities, all you have to do is find another agent that's got an assignment with those companies, and with just a simple letter of instruction, you can have them be the servicing agent on that account. They don't necessarily have to be the one that sold you the instrument. Same thing with a mutual fund account. You just have to find an advisor that's got an assignment or can sell that company's products. Letter of instruction or some forms allows them to be the agent of record, allows them to service that for you. Now, some insurance companies I know, because I get these calls, will call me when an account becomes orphan. They'll say, hey, listen, so-and-so is no longer in the business. You're an agent local in that area. Would you reach out to these people and see if they would let you be the agent of record? So we know that client, that customer is getting serviced. You may be an orphan client and don't even know it. When's the last time you talked to the advisor who maybe sold you that financial instrument? If it's been a number of years, you might want to check on that to see that they're still there, they're still able to service that for you. The reason you want to get an advisor involved as well is because, what if it's managed money? Wouldn't you want them advising you as to, what you should do? Maybe you want to change course with the strategy. If you're just passively invested the way he or she had you set up, then, maybe there's a change that needs to be made. If it's a financial instrument like an annuity where it has these interest crediting strategies, where's the advisor advising you year after year on making any changes? I think people basically prefer a face-to-face meeting, so all the more reason that you're going to want a servicing advisor that's local, somebody you can go visit to and talk to. So I encourage you, if you're somebody that's an orphan account, give us a call. We've got a lot of assignments with insurance companies, managed monies, mutual funds. We could be of help to you. So if you suspect you're that person or are, give us a call.
Hi there, my name is Nick Greenman. I'm one of the financial advisors here at Centennial Wealth Advisory. Brand new to the Gaylord office. I'm here full-time now, and I'll also be commuting back to the Petoskey office as well. I'd love to hear your story and learn if I could help you manage your retirement needs.
7 mistakes you make when choosing an advisor. Number 1, not picking an advisor that's a fiduciary. Now, a fiduciary is just somebody that has to act in your best interests, okay? Obviously, everybody wants that kind of an advisor, you would think, but not all advisors are fiduciaries, so that's number 1 mistake. Second mistake you make is just hiring the first advisor you see. If you're looking for an advisor, you're looking for somebody that you connect with, that you're going to trust, then I would dare say I would visit more than just one. I would maybe see 1, 2, or like say 2 or 3 at least, just to get a feel for, the differences with advisors, to pick one that might be a better fit for you. Number 3, choosing one with the wrong specialty. Now, if you go to an advisor that just sells insurance products, what do you think is going to be the answer to all your problems? Insurance, right? If you pick an advisor that just selling stocks, bonds, mutual funds, what do they think is going to be the answer to all your problems? You guessed it, right? So you're going to want to understand, if it's somebody that's more independent that can sell a vast array of financial instruments, might be a better fit for you. Number 4, picking an advisor with an incompatible strategy. If you're picking an advisor who works really well with somebody that's in the growth and accumulation phase of their life, they're working and take on a lot more risk, and yet you're somebody getting soon to be retired or retired, that advisor might be incompatible for you because they're looking at more growth strategies when what you really need is more preservation and wealth. So picking an advisor that's got an incompatible strategy. Number 5, not asking for credentials. That's very important. You see those commercials on certified financial planners and how the guy ended up being a DJ or disc jockey, and they were going to put all their money with this person. What kind of credentials they have, but even most importantly, what kind of experience. Has that person been in the business for quite some time? More likely, if they've been in for 20 years, they've experienced the last 2 market drops, and maybe they're going to be, that experience is going to, help them in making forming a better strategy for you, and also knowing what's out there and what's available. Number 6, not understanding how they get paid. People want to know how people get paid, and it's very important. Are you paying too much? But transparency is a real key to that. Number 7, not getting references. Now, a lot of advisors, they can't give you testimonials. That they're not allowed to do that. They can't post them on websites, but they can get permission from some of their clients to allow their name to be given out for referrals. So sometimes if you just want to see how a person's operating with others, ask for those referrals. And I'll give you a bonus mistake, not calling me. I encourage you, if you're somebody that needs an advisor or just wants a second opinion, call Centennial Wealth.
Larry, that was 2 wonderful segments that you have here. The first one I really want to spend a few minutes on those orphan accounts. I mean, it's amazing how many times we see people come in for the first time appointments. They want to have a no obligations free review of their accounts, and we're walking through things and they throw this statement on the table that's maybe an account that was written years ago, whether it's a life insurance policy, an annuity, sometimes even an investment account that they haven't heard from an advisor for years, and just kind of I get statements, it's okay, I don't know much about it. But that's scary when you have something that you don't know, and if nobody's looking out for that, is that product appropriate? Are there better options out there? You deserve it yourself to know that and have somebody looking out for that. You're paying fees, all along likely, and so you should have somebody know that. I mean, that's like driving a car without any mechanic to help back it up if it breaks down alongside the road. You're going to have this investment that maybe at some point needs to be serviced, and if you have nobody to call or talk to, it could pose a challenge.
Good analogy, Art. And what really comes to my mind, especially when it comes to life insurance policies, and I've come across a lot where people may have written it, oh, my dad helped me set this up 30 plus years ago, and no, I'm good. And then I ask a few questions and start to dig into it and ask them for a bit more information, or hey, you might want to request what's called like an in-force illustration to see what does this policy look like for the next 10, 20 plus years of your life. And sure enough, when they get that back, a lot of times, guys, it comes back to say, well, you may not be as good as you thought you were. What could happen is the cost of insurance goes up, and therefore the small premiums that you're paying aren't covering that, and so your cash value could deplete it, and ultimately your policy could lapse. prior to you passing. And so those are details that it's helpful to sit down and walk through, obviously with a licensed agent that understands life insurance.
Yeah, guys, the one I hate to see is when I see somebody that got sold a variable annuity and that agent set the interest crediting strategies up, and then they don't call the client because they received a commission up front. Now there's no incentive to stay, to service the client, and they might be taking more risk on than they even had any clue about. So having a servicing advisor associated with these accounts is going to be very important. Now I want you to stay tuned, because in the next segment I'm going to be talking about the coronavirus and basically how that affects the market. So stay tuned.
If you're retired or soon to be retired, let us help you plan to retire well. Centennial Wealth Advisory specializes in retirement planning and has offices in Traverse City, Cadillac, Petoskey, and Gaylord. We'll never pressure anyone to become a client. Our goal is to inform and educate. Simply attend one of our live events or schedule a meeting at one of our Northern Michigan office locations for a free, no obligation retirement review.
Coronavirus. Have you ever wondered how that can possibly affect the markets? Listen, every now and then we'll have what's called a black swan event. Something that happens, it's unexpected, and it can strike a lot of fear in the markets and drive it down. One thing about the markets that you got to be aware of is, you can have a supercomputer with 1,000 different factors that can predict, under certain circumstances, based on these 1,000 factors, what the market's going to do, right? But there's one thing you can't put in that supercomputer. That's human emotion. So things like coronavirus, people start getting scared. They fear they fear what's going to happen in the world. They're going to drive down the market because of that fear factor. But for the most part, in the long haul, the market is all about earnings. You've heard me talk about this time and time again. The market trades at a multiple of its earnings. Historically, that's been around 16, 17 times earnings. That's the thing we want to pay most attention to. Now, as we look at this coronavirus, can it affect earnings? Absolutely, and I think that's why we've seen such a reaction to it. The most importantly too is that it can strike at consumer confidence. Consumer spending is 70% of our GDP. 17% of our GDP is small business spending. So there's 87% of our GDP that's based on consumers and small business spending. If they're feeling good about the economy, for the most part, that can hold things up. But when you throw coronavirus in there, that starts to make people want to step back and hold off and wait on certain purchases. Think of travel. If you're scared you're going to go to a place that, where it might be more contagious, you're not going to take that trip. You might spend that money more here in the United States, which would possibly be good, but you're certainly not going overseas. Look what happened to the airline industry. And then look what that low demand did to oil prices and that. But here's my thing. Feds are trying to step in. They're trying to lower interest rates. They're trying to, try to calm the fears. But I dare say if demand is down, that affects revenue. And there's not a whole lot you can do to change that. The feds can lower interest rates. They can make it easier for companies to pay their debt. But that's kind of a below, down in the expenses. If revenue is, let's say, 20% down, how do you get that back? Because that directly affects bottom line. That affects earnings, which again affects the market. Now, an unintended benefit that came from those lower interest rates is obviously better mortgage rates, which does help consumers. Lower oil helped consumers, but I dare say this coronavirus is did wreak havoc around the world, but I just thought maybe you want to understand how it affects markets. So hopefully you found that valuable. Stay tuned.
All right, well, you guys look pretty healthy, so I feel comfortable sitting next to you right now. But it does remind me, too, I think back to 2014, I believe it was, with the Ebola virus. And I remember markets reacted pretty quickly to that as that was a major scare. And it is something where there's a lot of emotional reactions going on. And that's where it's important to be really looking at how you're structured and ultimately understanding what that risk tolerance is for you, because times times like this where markets are moving a lot, it can really cause you to take a second look at that ultimately.
Absolutely, John. I think these events are very unfortunate. Anytime people's health is in jeopardy and lives are lost, it's unfortunate. But when you look at this from a financial perspective, I think back even just the fourth quarter of 2018, right? Markets dropped quickly in December of 2018 and then recovered fairly quickly in early in 19. And then now we have this market drop again here in February into March. And, what does that mean to you? Where are your comfort level is? We've learned this isn't the first time we have quick market drops. And, more than likely, it's not going to be the last time we're going to have that. So if you're seeing your accounts move more than you're comfortable with, it's probably time to reevaluate your risk tolerance and where your accounts are positioned in that matter. Maybe you haven't had a conversation lately with your financial advisor on how things are structured, or maybe quite frankly, just your position in life has changed. Maybe you're closer to retirement. Maybe you're closer to needing that money versus putting money in. All those things can determine, what you should be invested in and your comfort level.
Yeah, guys, what I'm waiting to see is, first quarter results are going to start coming out, and I told the audience, everything's about earnings. So if earnings really got hurt here in the first quarter, this might not be over. And then see how long that lasts. If it goes into the second quarter as well, we might see this be a little bit volatile for some time. So, yeah, and as I said, if you're somebody that just wants to make sure you're positioned appropriately in any situation, really, because these black swan events can come out of nowhere, then absolutely give us a call. We sit down, kind of show you, kind of analyze your portfolio, see how you're sitting, how much risk are you taking. So give us a call.
Hi, my name is Jack Clunner and I'm a financial advisor with Centennial Wealth Advisory. My wife and I moved up here 13 years ago and we have really enjoyed raising our 4 children in the beautiful northern Michigan country that we have. If you've been watching the show for a while, you know what we specialize in. If you are at retirement or near retirement, give us a call. Call the number on your screen. We can help go through all the different aspects of planning that are involved in retiring well. So I look forward to hearing from you.
What are the 4 C's of banking? Have you ever heard this? Well, let me just walk you through them. The first C of banking is what we call character. I remember a story of my dad telling me when he was in the Coast Guard, and he was overseas or just got back into the States. We had been in Spain for 2 years. He needed a car. And I remember him saying that he was able to call his bank right in Traverse City, Michigan, and they literally was able to get him the funds to get buy that car without any paperwork. When he finally got back here to Traverse City, they finished up the paperwork at the time. They did the loan solely based on my dad's character because they knew who he was, they knew that he was from here, and so they were able to do that loan. The second C of banking is what you call collateral. Collateral. It used to be, the farmer could come into the bank and show you, he'd have his tractor or some equipment that he could put up for collateral, and the bank would just give him a loan based on that and maybe his character, right? But all they had to have was just sufficient collateral to do the loan. The third C of banking is cash flow. What is the ability of that person to pay that loan back? Now, I saw a time there in the banking industry for some time where collateral was not enough. All right, they could have the best of character and they had the best of collateral, but if they couldn't sufficiently show through their financial statements that they had the ability to pay that loan back, and weather maybe even a downturn, then they were not going to get the loan. And then the 4C in banking is what they call credit. All right, very, very important. Today you have agencies that can rate you. You know, they look at your past payment history. They look at what kind of loans you have out there, how much you're using on the credit card. You know, all kinds of factors into determining and giving you what they call a credit score. Now today I see a lot of banks, you know, loaning, you know, almost entirely on that credit score. What kind of an interest rate you get is going to be based on what that credit score is. So all of these are important. Your character obviously is going to be important. The kind of collateral you're putting up for the loan is going to be important. Cash flow, you better be able to pay it back, right? And have a good credit score.
You made it. Years of hard work, investing, planning, and now you're here. The long-awaited reward you spent a lifetime looking forward to. But what now? After years of growing a nest egg, now you may want to manage it. Use it to fund your dreams. Make it last as long as you need it. And leave some for those you love. So what do? Wall Street continues to be uncertain, and some conservative options have dropped through the floor. How do you maintain opportunities for growth and reduce risk of loss from market changes? That's where we come in. We are financial professionals. From investments and insurance products to tax reduction strategies and guaranteed retirement income you cannot outlive, provided by the claims-paying ability of insurance companies. You've worked a lifetime to get here. Let us help you enjoy it to the fullest. For a complimentary consultation, simply contact us today.
We look forward to helping you plan to retire well.
Have you ever heard about opportunity zones? Well, they can be a huge tax advantage and possibly a good investment instrument if you understand what they're about. First of all, let's just say you sold some tangible property. All right, you sold it for $300,000, but your cost in that property, or what is called your basis in that property, was $200,000. So what you ended up having happen after that sale is you now have a $100,000 gain, which you have to pay tax on. If you take that gain and only the gain only, all right, take that $100,000 and put it into an opportunity zone, I want to explain what the tax advantages of that could be. First of all, if you hold that asset, the opportunity zone you purchased in, and you hold it for at least 5 years, then out of that $100,000 gain, you only have to pay tax on $90,000 of it. So you got to exclude $10,000 of the gain. Now, if you hold that property for 7 years from the date of purchase, you only have to pay tax on $85,000 of that $100,000 gain. If you hold the property for 10 years, then you still only have to pay tax on $85,000, but plus the rest of the gain you don't have to pay tax on. So let me explain. Let's say that investment of $100,000 in the opportunity zone in that 10-year period, let's just say it doubles. Now that property's worth $200,000. Well, because you had zero basis in this gain, you were going to have to pay tax on $85,000, but now that other $100,000 that it grew to, you don't have to pay tax on it. So you're excluding out of that $200,000, you're excluding $115,000 of gain. Pretty interesting, right? Now, the one caveat to this is that by the year 2026, the tax on that $85,000 gain, the tax has to be paid in that year. Don't tell me why they set it up that way, but that's basically when they wanted to do it. Now, what constitutes an opportunity zone? If you just Google opportunity zone opportunities, you're going to find all the areas that the government has designated as an opportunity zone area. They're usually distressed places with a lot of old buildings, and they're trying to encourage investment in raising the standard of living in those areas. So encourage you to Google that. There's funds out there that basically have diversified properties within them that you can invest in. But if it's something you'd be interested in, want to learn more about, just give us a call. We'd be glad to talk to you about it.
Boy, Larry, what interesting segments there. I mean, that's, I think, two things that we've never talked about on the show, probably, of all the years, that the show's been airing here. It's an interesting story with banking and stuff, and your dad coming back, and, how banking has changed over the years, and just the difference of that, and it has evolved over time. And maybe you've had financing recently, and all the stacks of paperwork and stuff that you have to go through. And then I think of like the 1035 exchanges and the opportunity zones you talked about, general tax planning with properties. So often we see people make financial decisions without thinking through that process, and maybe what the advantages and disadvantages are to that decision. And versus just jumping into something because they think it's a good idea.
Yeah, and that's where tax planning really comes into play when it comes to, especially with your investments as well, and you may have capital gains, unrealized capital gains, where the portfolio has grown to a certain level and you're thinking about selling, but you might hesitate because you're concerned about what those tax ramifications might be. And that's where you've got to weigh that decision, right, of well, do I pay the taxes because I've made the money, or do I wait it out, and worst case scenario, that value goes down to nothing and you don't make those gains, but you don't pay the taxes. So you've got to be paying close attention. And that's something that we feel at Centennial Wealth Advisory is important. It's not just an understanding of what your investments are and how they're structured, but then understanding behind the scenes sort of the tax ramifications of the different decisions you make, and ultimately how you're going to structure your retirement income. That's vital when it comes to planning, and going along with that comes in different estate planning or different ideas, like Larry talked about, these opportunity zones. There's a lot of information out there, and that's where we encourage you to come in, sit down with us for a no cost, no obligation second opinion, because our goal is to help you plan to retire well. So thanks again for tuning in to Retiring Well.